Prothrow case, Campbell v. Prothrow, where there's mere appreciation regarding calves that were being given to charity, okay? And in that case, the gift was effective. Compare and contrast it on page 267 with the paragraph that goes from 267 to 268, the Tantum v. Commissioner case, Tantum v. Commissioner. In that case, okay, the crops had already become monetized. Okay? In Tantum, the crops had become monetized, and because they had become monetized, essentially they constituted red apples. They were ripe apples. So for your notes, if you haven't had a chance to do tonight's reading material, we had this Rutgers ruling 69-102, and we have one case for the proposition, Campbell, for the proposition that mere appreciation is not subject to immediate tax, where the converse of that is this Tantum case, spelled out on page 267. And you can see that it results in a very different outcome. But we're gonna, after the break, we're gonna go through this. So even if you didn't read the material, I think by going through the examples or the problems, I hope, fingers crossed, that I hopefully can shed a lot of light on this revenue one. Now, final word before the break. When it comes to dividends, what is the important date of who gets taxed? What is the important date? Okay? Is it the declaration date? Is it the record date? Is it the settlement date? Is it actual receipt? What is the important date here? In what control? Vikram?
The settlement date.
Is that what it says? Usually, Vikram, usually, but not always, in the closely held business context, it could be different. But generally, it's going to be the record date, okay? Not the declaration, it's who owns the stock on the record date, who's entitled to the dividends. And that's going to dictate when that person is taxed. And you can read this. And again, we're going to go through some examples. So here's what I'm going to propose, and I'm going to really test you guys out tonight. And this is going to be a good way for you to meet people. When we come back, why don't we take our 8-minute break? But, and here's where it's going to be the challenge. Can you guys line up outside and introduce yourselves by last name so that I get whoever's the last name with an A first, and all the way in the back, whoever has the last name with a Z. Because I have the exams that I want to distribute them based on alphabetical order, okay? Does that sound like a fair game plan?
So we can be outside.
Outside. Let's do it outside the room. And we'll try it. So take a break, get your drinks, bathroom, whatever, and then in about 8 minutes line up. And then we're going to go through the problems, and then we're going to talk about business expenses at the very end, okay? Yeah. All right, guys, let's talk about this. All right, let's go through this. Now, taxpayer owns Apple stock. He owned it for several years and purchased for $10. At the time, the stock is worth $9. Suppose she gets the stock to her daughter, who sells the stock a week later for $11. Okay? So she purchases it for 10. At the time when it's worth 9, she gives it to her daughter, who sells it at a gain. Now, What is the amount of income in the character? It's $1 a game, right? It's a carryover basis, right? It's a carryover basis of 10. Sells it for 11. $1 gain. Apple stock is a capital asset, right, guys? And isn't code section 1223 long term? Don't you get the holding period of the holder? By the way, just so you know, because people will inevitably ask this, the class average was about 62. And what this means, generally, I try to get like a B curve. So if you had somewhere between 55 and 65, it's in the B range. You know, 65 to 70 B plus. Anything above 70 might be in the A minus range. You can do the arithmetic. If you were in the 50 to 55, maybe in the lower B range. You know, below 50 is probably in the C range, just to give you an idea. So I don't put grades on these. Your final exam is more heavily weighted than the midterm. So, you know, if you had a 45 on this exam or a 50, I've had people who, you know, all of a sudden there's a wake-up call and they say, you know what, I want to really do well. I haven't spent the time I should be, or they're not studying properly, and they're really able to turn it around. And I've had people take their 45, 50 and end up with an A minus in the course. And I've seen people who rest on their laurels, who did very well on this, and then on the final exam, they don't put the energy they need to, and they don't excel. So, you know, the ball's in your court. My perfect world, come Christmas time, it's nothing better gift that you guys can give me is that if you really do well in the final. Like, your mastery will give me the best holiday gift possible. So I need you to do well. I'm here. I'm not going anywhere. So if the upcoming weeks you have questions or issues, or if you want to know certain things, make it happen. Back to this, and then concluding comments. At the time, the stock is worth $11. She gives the stock to her daughter, who later sells the stock a week later for $9. Well, at the time she gave it, it was appreciated, so the $10 remained as her tax basis. So here it's a $1 loss. Now, several of you said, oh, $1 loss, it's a 1231 loss. No. This is not an asset used in a trade or business. It's Apple stock. It is a capital asset, right? So it's a $1 loss, capital loss. Question C, at the time the stock is worth $20, suppose she gives the stock to her daughter, who sells the stock later, a week later, for $1. Okay? Well, again, same $10 basis. She has a $9 loss, capital loss, right? Question E, at the time the stock is worth $9, suppose the taxpayer dies and bequeaths the stock to her daughter, who sells the stock a week later for $11. Okay? Well, what rule comes into play? Instead of 1014, excuse me, instead of 1015, 1014. There.
Are we going to be able to keep these?
Yes. So here, code section 1014 takes hold. So the basis equal to fair market value rule applies. And therefore, when she sells it for $11, she has a $2 gain. And at the time the stock is worth $11, suppose taxpayer dies and bequeaths the stock to her daughter, sells the stock a week later for $9. Well, that's a $2 loss. All long term, because code section 1223.9 says it's automatically long term. Right? Now, I will say this, you guys may disagree, on a level of 1 to 10, 10 being the hardest, 1 being the easiest. I was not aspiring to, the world of 10. It was just designed to be in the net range of about a 2 or a 3 in terms of complexity. All right? So on the final, you're going to see very similar. Anything we cover in class, Nothing beyond it, okay? And even if we cover it in class, I'm not gonna ask the hardest thing about it. I'm gonna try to keep it really straightforward. The less I have to mark your papers, the easier it is, the faster I can go through them. So nothing gives me more fun in life than a perfect exam is great. Takes me, you know, no time to go through, where if I have to mark X's, that's not good. So you guys have to help me out here. You follow?
Why is 1A is not 1001C? Why is it 12.3?
But go slowly with me. Tell me which question.
1A,
What about 1A?
that gain of $1, why is it not 1001C? Why is it 12.3?
1001C. I don't understand. 1001C was about gain recognized.
That's regular earning, right? Regular income. Why is it a capital gain?
It's a capital asset. I don't understand. What else could it be? Gain is not a character. Right? What is gain? That's not a, we spent weeks talking about 1245 income.
Would this be ordinary income for the person?
How could it be ordinary? It's stock. It's capital asset. Didn't we spend a whole chapter 21 talking about capital gain and the consequences of it having that character? And then by way of contrast, 1231 that sometimes gave rise to capital gains, sometimes ordinary losses. And recapture income, 1245. Unrecaptured income, 1250. I mean, we spent 3 classes, I think, 9 hours talking about character. Right? All I'm saying, and I'm not trying to be harsh here, to follow, for clients and for fellow practitioners or your supervisors, when you talk about character, don't tell them about gain. You better tell them if it's capital, ordinary, recapture, and the consequences, right? Far more important than whatever I can convey is what you have to do outside the classroom. Question 2. A owns machine A. She purchased several years ago for $100. It took $40 worth of depreciation deductions. The machine B that she purchased several years ago for $100, it took $10 of depreciation deductions. So, several people during the exam, I couldn't say much, but I sort of looked at them, said, well, what kind of assets are these? Are they 1231? Well, once you hear the word depreciation deductions, we've said, they're machinery used in a trade or business, or else you couldn't get depreciation deductions, right? By their very nature. So what happens to the basis of these properties? They go down. They go down to 60 in the case of machinery A, and 90 in the case of machinery B. Now, what are the tax consequences if machine A is sold for $60 and machine B for $95? Right? Well, there's no gain on machine A, and there's a $5 gain on machine B. Right? Everybody agree? What's the character of that? Sorry? Ordinary, right? Why? What code section? Sorry? 1245, right? Why did you put capital? You forgot your peanut butter and jelly. You can't think 1231 without thinking 1245, without danger. What happens in the tax consequences if machine A is sold for $10, machine B for $10? It's a gain or loss here. Loss of how much? 130, right? What's the character? Ordinary, right? Because the losses exceed the gains.
So quick question. So, can you explain how you got one?
Well, I mean, didn't we sell machine A for $10 and what was its basis? 60, so there's a $50 loss on that. And as in machine B, the base is 90, and you're selling it for 10, there's an $80, so 50 plus 80, $130 loss. Question C, what are the tax consequences of machine A is sold for 160, and machine B for 100? Isn't the overall gain here 110?
The answer is 16.
And how much recapture income do we have, Anna? What's yours? Laura? Kathy? How much? 50, right? Are we recapturing all the prior depreciation? And the other 60 is what? 1231 gain or capital gain, right? I accepted either answer. The first 50 is recapture income. The other 60 is 1231 gain. You have to bifurcate the gain, right, Angie? Yes?
So the 50 is the depreciation from.
The prior depreciation on machine A and machine B. Right? I thought you'd get bored with looking at these questions. How many, we did several of these during class. Suppose the current year machine A is sold for 160 and machine B for 140. What's the overall gain here? 150, right? Once again, Angie, 50 recapture, 100, 1231 gain. Does anyone want to tell me who got it wrong? Like why? Like what was the confusion? Jason?
For me, it was because you only get the one space on the test, on the answer sheet for income. So when we had to split it up, I only put the gain, not the recaptured income.
So when they asked for character, what did you put as character?
I put the gain.
I mean, you saw during the problems we did, we bifurcated the gain. I mean, there's no perfect way of doing it with Jason, but if it were a supervisor, he's, gonna say, bifurcate 1245, 1231 gain. Right? The word gain doesn't help. That's not character. Question 3. Go ahead, Ron.
I was gonna say for question 2, where I got confused was, I saw taxpayer instead of corp, and I treated it as a non-business, and that's why I put capital. So when I saw taxpayer instead of corp, I
Yeah,
treated it as.
but that extends to corporations and individuals. I mean, 1231 is a universal code section. It's not limited to corporations. It goes to partnerships, S corps, individual proprietors. You never said this code section 1231 is unique to corporate taxpayers. It's a universal code section. Okay, other questions? Question 3. Suppose the taxpayer goes to a flea market. Gets back to the Cierini, however you pronounce it. Cierini case. Goes to a flea market, purchases a lacquer box for $20, and subsequently discovers the box is made out of gold, worth $10,000. Even better, on the way home, she finds a gold coin. Lucky her. Mike.
So when I heard this question, I assumed gold coin was in the box.
Yeah, but I mean, that doesn't make sense. She's on her way home.
Yeah, so she's opening up, the whole point is like, the fact that two.
But I don't even know if that changes your answer.
So what I said in this question was.
I mean, with respect to this purchase, does she have any income?
Yeah, so the purchase simply because the gold coin was in the box,
I mean,
that itself would have been.
Like the
It's
money
like
in
a
the piano.
Yeah.
That's what I thought.
Yeah.
No, it's not the concept.
guys, I mean, that's a stretchy on her way home, she finds a gold coin.
I just assumed it was in the box.
Me too.
Me too.
I did that.
Listen, there's never gonna be the perfect exam, I can't.
Money in the piano, money in the piano.
All right, with respect to this purchase, how much income, if any, does the taxpayer have? And the notion is, typically with a purchase, you have no income, right? Bargain purchase. That's what I was looking for. You purchase the lacquer box, even if it's very, like the Steinway piano, no income.
But wait, even if you found the gold coin, it's found lost, you still have to report it.
No, you do, but when you buy, the actual purchase of the lacquer box does not give rise to income.
What about the gold?
Well, what?
Because the gold coin was not the.
But that's not asking about the gold coin. This
We
is,
thought the gold coin was inside the box, but it wasn't.
if the taxpayer subsequently sells the lacquer box for $20,000, how much income, if any, does the taxpayer have? What I was looking for is $19,980, right? Because, and what kind of asset is the lacquer box, guys? It's capital asset. Why? Because section 1221. All assets are capital assets, right? Except for some narrow exceptions, but this isn't it. So many of you put ordinary income. It is not ordinary income. The taxpayer sells the lacquer box for $5,000. How much, if any, in the income does the taxpayer have? And again, here, I was simply looking for $4,980. And again, capital. Question D. The taxpayer sells the gold coin for $60,000. How much, if any, income does the taxpayer have? Well, you're right, Elizabeth. Taxpayer, when they found the gold coin, should have reported it. We said this, just like baseball, you should report it. That becomes your tax basis, right? The tax basis here would be $50,000, and therefore, when she sells it for $60,000, what happens? $10,000 gain, long-term capital gain or capital gain. The taxpayer subsequently sells the coin for $4,000. How much income, if any, does the taxpayer have? In this case, we're just looking for a $46,000 loss, right?
Well, here's my other question. If this is a person, how do they take a loss on a personal line? You can't take a personal loss.
Well, gold coin is more, well, we're gonna get to that in a second. A gold coin is not like a personal use item, okay? It's not like a piece of jewelry, right? Go ahead.
In the Cesarini or treasure trove, why was that immediately considered income? This is considered a gain.
Well, this is considered income immediately. The person has to report the $50,000 of income the coin is worth. I'm not sure what your question is. They subsequently sell it. Taxpayer purchases a building for $100,000. She pays $10,000 cash and borrows the remaining $90,000. She takes $40,000 of depreciation. And
Would you please repeat it? Section 3 PNC's amount of income, please?
your question is what?
Would you please repeat PNC's income, the amount of income for 3 PNC?
Well, if she sells the lacquer box for $22,000, it's $19,980. She sells it for $5,000, it's $4,980.
Thank you.
Right, question 4.
Purpose before you move into that one. So, you said that there's for 3D, it's a 10,000 income.
Right, capital
So
gain.
even though she just found, she did not pay the $50,000.
No, she's got to pay tax when she finds the coin. it's presumed she's gonna pay tax on the 50,000. Didn't we discuss that? When you find the baseball, you have to report that, that becomes your tax basis.
Even though you don't sell it?
Even though you don't sell it, we've had this conversation. When you, Regulation 61-14, Regulation 61-14 says you find treasure trove, it's immediately reportable. That becomes your tax basis. When you sell it, you experience a gain or loss. Now, a taxpayer purchases a building for $100,000. She pays $10,000 cash. She borrows $90,000. Sounds like the Crane case, right? She takes $40,000 depreciation deductions. What's her basis in the property? 60. Everyone agree? Suppose in year 5 she sells the building for $200,000, and the buyer paying $110,000 in cash and taking the property subject to liability. Any gain or loss here? Gain of how much? How much? 140, right? Why? 200, code section 1001. 200 less 60, right? 140 gain, right? What's the character? Don't we have 1250 unrecaptured income of 40? And the balance? Sorry, Jason, but did you make room for the two? All right. You don't mind if you did it for that one, you should have done it for the other one. All right? Tan, you get that?
Yes.
So if it was 100 of 1231?
Yeah. 40,000 unrecaptured, 1250 unrecaptured, and 100,000 of 1231 gain. All right?
Yeah, I'll talk to you after.
All right? Question B, supposing year 5 taxpayer sells the building for $100,000, with the buyer paying $10,000 and taking the building subject to the liability. Well, this is a simple, this is only a $40,000 gain, right? Right.
Why is this 1250 and not 1245?
Because it's a building. And 1250 always applies to buildings, 1245 applies to everything else.
The building isn't considered depreciable property?
It is, but 1250 is applicable to real property, 1245 is applicable to all other property.
1250 is buildings, 1245.
We said that during class. Right? That's the simple demarcation point. 1250 building, 1245 to all other property, period. Supposing year 5 taxpayer decides to abandon the building and gives title back to the bank. How much gain does the taxpayer, if any, does the taxpayer have? This is the Tufts case, right? What's the liability? 90. What's the basis? 60. Gain or loss? Gain of how much? 30. Character? 1250 unrecaptured gain, taxable at 25%.
What's the character for the 4B?
The what?
What's the character for the 4B?
4B is 1250 unrecaptured gain. Question 5. Taxpayer works at Walmart. Suppose the taxpayer receives 60% qualified employee discount on purchases. She purchases a TV, $1,000 TV for $400. Assume Walmart has sales in the prior year of $10 million and a $1 million cost of goods sold. Okay? So on everything it has a 90% profit margin. So is this a qualified employee discount? Why not, EK? this a qualified employee discount, guys?
Yes.
Yes. This is fine. I mean, they're getting a 60% discount, and the company normally has a profit ratio of 90%. So there's no income here. There's no character because there's no income. But suppose instead in question 5B, taxpayer receives a 10% qualified employee discount on purchases. Assume further that due to a written reciprocal agreement, she can secure a 10% discount at Target. She purchases a TV, plasma TV for $900. Assume that Walmart had sales in the prior year of $10 million and cost of goods sold of $1 million. Does she have income? And what I was looking for here is, with respect to reciprocal agreements, what kind of fringe benefits does, if you look at code section, I think it's 132I, it deals with reciprocal agreements. What kind of fringe benefits does that apply to? Only qualified services. Like if you work for Delta, you can go on United for free, right? It does not apply to qualified employee discounts. It does not apply to that kind of fringe benefit. So Target and Walmart can have this arrangement, but it's not going to be tax-free to the taxpayers. So in this case, 132I. So in this case, this discount would result in taxable income of $100. What's the character or ordinary income?
$100.
100. All right. Taxpayer purchases a dress, $100 dress, lets out for 80. Sells the dress for 110. Everyone numerically should get this answer right. Gain or loss? Gain of 30. This is the least, I don't know, I'm going to make this number up. 70% of you said ordinary income. What kind of asset is a dress? What? Capital. Gives rise to a capital gain. Right? What's my authority? Code section 1221. Andrew.
I think I personally, I had the assumption that she was selling it to the customer in the retail setting.
How can you say that? And why would that be inventory to her?
I don't know, that was just my mindset. That's the only reason I
Yeah, but I understand, but do you understand that when you think about the question?
right. I think there are certain things, at least on this page, that I overthought.
Don't overthink, guys. I have no agenda. My agenda is truly, I want you to do well. I am not looking to trick anyone. I do not have to derive zero satisfaction from tricking anyone. So do not overread for the final exam in this class or any other class I teach. This is meant to be literally, I didn't want to embarrass myself by taking it down to a 1 level. A 2 or 3, I don't think it's embarrassing for me, but this was not designed to be at a 10 level, right? I didn't want it at a 1 level because then you might say, hey, I learned all this in undergraduate tax, but that's all. Question 2, she sells it for 90. Well, again, that's easy enough, $10 gain, right? Nothing tricky, capital gain. These are supposed to be easy points. And then finally, if she sells it for 70, I know Mike's been waiting for this. It's her dress. I'm hoping, Mike, I don't remember, but I hope you got this right. What'd you put, if I don't mind? Personal loss, disallowed, right? We went through this, code section 165. Now, I try to be gentle. Some of you got, I'll call it like wrong answers, and I circle things, and I try to be delicate here. I'm not saying I was perfect, but Anyway, I told you what the class average is. You know, in the final exam, you're gonna see more of this kind of stuff, but it's gonna be predominantly things we cover in the second half of the semester. But there will be questions where there's gifts, treasure trove, all that's free game on my part, okay? All right. And just send me an email and you can come up before class on a Monday or something like that. You're here part of professional accounting, so it doesn't have to be a Monday. 6C is disallowed, personal loss, no character. I just put a question mark, but you put $10 loss, but I didn't mark it wrong. All right. What? We got one more then. I didn't skip over 1D. All right, guys, let's go back to the material. I want to get back to in our textbook. Let's finish up chapter 12. All right, everyone have page 269 open? Father owns land he purchased several years ago for $80,000. It has a current fair market value of $90,000. Father leases the land on a 10-year lease and is paid $6,000 of rent each year, semi-annually, April 1st and each year, semi-annually, April 1st and October 1st. $3,000 each paid. So let's picture, if you will, that we have a father who's leasing and is paid $6,000 rent each year, and quarter one he's paid $3,000, and let's just say this is July 1 and this is October 1, right? What are the tax consequences to you? So let's just suppose this is year 2. Everyone have that? Father owns land. On April 2nd of the current year, father assigns daughter all future rental payments. So who's taxing year 1 on what? Okay? On April 2nd, he assigns daughter all the future rental payments. Jane, Patrick, who's taxed on this?
I think the father has all of his tax.
Patrick?
I agree with that.
What's the authority?
That whatever one.
Which one?
Probably the most. That's 69, whatever, yeah.
I would use Halbring v. Horse, right? Here the father maintained the tree, gave away the interest, but he kept the tree. On question B, father gives his daughter the land with the right to all future rental payments. So, name, Elizabeth, who gets taxed on that?
The daughter.
Daughter. Agreed? And what case would you cite to?
The Blair.
The Blair case, right? Question 1C. Father gives the daughter 1/2 interest in the land and the right to all future rent payments. So, Alvin and Kit. Sure. And Kit?
I mean, if the interest was given right before the timing.
So who, Vikram?
The daughter's is only taxed half the rental payments.
So
She only.
the father, when he owned, the father would certainly be taxed on 3,000, everyone agree? Because he owned the land and got the payment. What about this second 3,000? Vikram, you were gonna say?
Yeah, I was about to say, since she only owns half of the tree.
Right, so she should be taxed on 1,500, he should be taxed on 1,500, right?
Yeah. That's correct.
Everyone agree? Yes? Matt, you were gonna say?
I'm curious if that's actually the situation, because she's the one who's getting all the income, right? She's getting all that money.
Yeah, but it gets back to
tax
Helbring v. Worse, if he owns half the trade, he's gonna remain taxed on it.
for the entire time, forever, for the rest of that lease, he's just gonna have to tax.
Yeah.
He's getting no income.
Right, because he's kept the trade. I mean, take a look at that. That's a big difference than if he just gives away all the interest he owned in the property. Look at question D. Father owns an income interest in a trust which owns the land, and on April 2nd, the father gives his daughter the income right, or the income interest, that's the right to the succeeding rental payments to his daughter. So in this case, it's very similar to EK, Leo, and David, right? Where in this case, Leo is giving his income interest in the trust, which he owns the land. He's giving the income interest, the right to succeeding rental payments to his daughter. So Leo is essentially divesting himself in any further interest in his trust, and we know who's going to be taxed going forward, right? David, right? What's my authority? Blair.
So, David's taxable.
I'm sorry?
I'm sorry, who's taxable again? The adult?
David, the child.
The child.
Okay, question 8. On December 31st, New Year's Eve, father gives daughter the land with the right to all future rental payments. Okay, everyone get the visual? December 31st. Here we go. Dad gives it. So this is April 1st. And this is July 1st, this is October 1st. All right? In this case, Nick, Frank, Andrew, who gets taxed on what? Let's see if you guys are on the same page. Year 1, year 2.
Let's say the father gets taxed year 1, daughter year 2 going forward.
Okay, Frank, agree, disagree?
I agree with that, because doesn't, the April 1st, right after he transfers the fruit, ripens.
No, he's transferring it right here, December 31st.
Right, but that 4-1 payment would be for the rental between 10-1 to 4-1. So
Right, this is for the payment looking back, right? Because that's what the problem says.
So a portion of that would be, but yeah, so the father would be taxed on that 3K, and then going forward would be the daughter.
So you say what?
So I say the 3K payment would be taxed to the father.
You say this is taxed. We all agree dad gets taxed on this 6.
Yes.
With regard, you say dad gets taxed on this 3.
Like at high level, because otherwise, I mean, you could split the difference between like he transfers at 12/31, so you're saying 4 months out of the 6 months she holds it.
Well, she's owning it for 3 months. January, February, March, right? So the question is, well, Andrew, do you agree?
Yeah, I mean, I agree that that she pays the ongoing tax.
So just tell me, in year 2,
Yeah,
she's gonna get tax burden of how much?
she's gonna be taxed on the 3,000.
So you're saying debt 3, her 3? Yes or no?
I'm saying her 3.
I'm sorry?
Her 3, yeah.
3 and 3.
3 and 3.
Mike, you say,
I think she gets 6.
you think she gets taxed on all 6?
Yes.
Doesn't 69-102 apply here?
It does, but how does it apply? So Frank's saying revenue ruling 69-102 applies here, right?
Because he holds it, for a portion between 10-1 and 4-1, the father owns it.
No, from 10/1 to December 31st, he owns it, right?
Well, yeah, sorry, so there's a proportion that is assigned to him, and a
Ah.
proportion is assigned to her.
At this time, everyone agree, $1,500 of rent has accrued. Everyone agree? But he's a cash method taxpayer, right? So he wouldn't be taxed on this because it's accrued, but it's not been reduced to cash. Everyone agree? But it's right. This money is due and owing right now and then. It's not appreciated. It is truly an obligation on the part of the lessor, or lessee, excuse me, to pay $1,500, right? So when he transfers it to his daughter, he's not transferring a right to future rent, he's transferring a right of an existing rent obligation. And Revenue Ruling 69-102 says he should be taxed, when this $3,000 comes in, he should be taxed on $1,500. The daughter taxed on the other $1,500, and of course, she'll be taxed on the remaining $3,000.
I mean, 3,000?
Right.
So 4,500 total for tax.
Yeah. $4,500 for her in year 2. Carla, you got that?
Yes, sir.
Just making sure everyone's got it.
So,
Richard.
just to clarify, he's transferring the right to the child, right? Well, exactly what is he transferring again?
He's giving her the property, but it's already got $1,500 of right through. There's some ripe apples already on the tree, right? And this is truly an illustration of the Revenue Ruling 69-102. Okay, you got that? On April 2nd, father sells his daughter the right to 2 succeeding rental payments for $5,000, their former market value at the time of sale. Sound familiar, guys? The father sells the right to 2 future rental payments. Sound like what case? Sound like the Stranahan case, right? Anybody, by golly, that's what it is, right? It's the Stranahan case. So, assuming Stranahan is still good law, let's put aside the application of Code Section 77010. He would be taxed on $5,000, right? And how would the daughter be taxed? Well, she paid $5,000, right, for the right to receive 6. Everyone agree? So I'm oversimplifying it a bit, but essentially each payment, she would get a $3,000. Her basis is $2,500 with respect to each payment. So with respect to each payment, she would be subject to tax of $500, and she got 2 payments, so she would end up being taxed on $8,000, which makes sense, right? There's $6,000 worth of income here. Dad's gonna be taxed on $5,000, daughter should be taxed on $1,000, right? And again, she paid $5,000 for the right to get $6,000. On April 2nd, father sells the land and directs that $90,000 of the sales price be paid to his daughter. So who gets taxed on the gain here? Father or daughter? Father or daughter here? Francis, who gets taxed here?
The father.
What's your authority? Okay.
The daughter would be, liable for the tax?
Why?
Not sure the case, but he's assigning all the income directly to her.
Mike, does that work?
I had the father would be taxed.
Why?
At 10,000, due to the,
Salvatore case, Susie Salvatore. I think, and it's the other way around, right, Francis? You had it, but I just wanted the authority. That the father would remain taxed upon the gain. Because the sale was about to happen. How about question 8? Prior to April 2nd, father negotiates the above sale, and on April 2nd, he transfers the land to the daughter, transfers the land to the buyer, who pays the daughter $90,000. Mike, would this change your outcome?
no.
No, right? The outcome should be the same, right? Question 2. Determine who is taxed on the lottery winnings below if Lucky purchases a lottery ticket and gives it to child prior to the lottery winner being announced. The ticket is the winning $1.5 billion. Amanda, who gets taxed on the $1.5 billion?
Child?
Why?
It's not recognized yet, so.
Hasn't ripened, right, Vikram?
Because I said because of Salvatore.
Well, the Salvador case, I don't think it actually, that one the taxpayer lost, and here the taxpayer would prevail, right? Go ahead, Matt G.
Is that 16, revenue ruling 69-102?
Well, you could cite to the, just for the proposition, this income is not right. Right? Until the lottery number is pulled, the income is not right. Question 2B. Same as A, except Lucky's gift occurs after the lottery winning is announced. Maddie, same answer, different answer?
Same, oh no, Lucky pays now, because it's ripened.
Yeah, if it's ripened in his hands, he's got to pay the tax, right? Right? Now, lottery wins the lottery, but properly elects to have the income tax in the form of an annuity each year for 20 years. After 2 years of annuity payments, Lucky gives the remaining 18 years of payments to child. Who should be taxed on this? Dan, you were going to say?
Lucky.
Why?
Because I think it's still, I think the fruit's still ripe at the time of winning the lottery.
Yeah, I mean, this you could see both ways, because this has an aroma like pear, right, where you gave away the entire tree. But it really did mature in his hands. Now it's just a question, he's a cash method taxpayer. And as a cash method taxpayer, it's being deferred. So I would have Lucky still tax on these lottery winners.
President,
Yes.
I don't play the lottery much, but if he gets it deferred for 20 years, if he dies, doesn't he stop receiving it?
Yeah, but then there's the code section 691. If you look at code section 691, you know what 691 is? Refers to anyone in the room? Called IRD, income with respect to decedent. What is the biggest item of IRD of all your clients? Mike, you seem to know. Like that. What is your biggest IRD item? Say again?
Social Security?
No, because once you're dead, Social Security ends. What's your biggest IRD?
Oh, your pension?
Retirement. IRAs. So when you die, does code section 1014 apply to retirement income? Your IRAs and your 401ks, your clients' 401ks, 403bs? No. Do they get a step up the basis? Absolutely not. If you look at code section 1014, it specifically excludes items of IRD. So that I die and all my IRA money goes to my daughter, my son and daughters, they would be taxed on it. Why? Because it's items of IRD. That money, that never escapes tax. It's never been taxed once. So I forget who asked the question, Andrew. So what was the question again?
Well, no, I was under the assumption that if you died, you wouldn't. I thought that the lottery payments would stop.
Oh, no. I mean, if you look at the annuity, it keeps being paid, but the annuity then would be taxable to the beneficiaries as items of IRD. Okay?
Thank you. Because in my mind, I was thinking, well, then, because of that, it wouldn't be guaranteed income, but thank you.
Most of those lotteries are, once you elect, guaranteed to be paid out. Inventor develops a new electrical switch, which he patents, and who is taxed on the proceeds if the patent is transferred gratuitously to son who sells it to buyer. Now, if mom transfers it to son, and you've got to imagine mom worked hard, right, to create this patent. Everyone agree? Mom spent hours and hours. And on one hand, you might think, Lucas Vieral, if you perform services, you should be taxable on it, right? And you might draw the conclusion, mom should be taxable, right, Jacqueline? You might. However, once you take your services and you commoditize it into an asset, in this case, a patent, right? And traditionally, when you give away, like I was giving Kim Apple stock that had appreciated in value, and she subsequently sold the Apple stock, she got pegged with a gain. Everyone agree? So the author's point in raising this is if you take your services and you reify it or commoditize it into an asset, in this case a patent, the case law on this is pretty clear that the son would be taxable on the gain, on the patent. Even though you might, under Lucas Vieral, think, gee, it's really mom's services that she assigned vis-a-vis this patent to her son. That's not what case law says. All right? So in this case, son would be taxable on subsequent royalties. Inventor transfers all of her interest to a patent to a buyer for a royalty contract and then transfers the contract gratuitously to her son prior to receiving any royalties. And believe it or not, in this case, here, again, mom was entitled to all future royalties, but in this case, it held similar to the Blair decision that going forward, the son should be taxed because mom gave up the entirety of her interest in this property. Go ahead, Frank.
Could you argue opposite of holding 69 on the 2?
You could. I'm just saying, if you look at this case law,
Sure.
it could go either way. The courts here have said that this is an effective gift. So I don't, we could make the argument, but at least under current law, stare decisis, we would lose. All right, give me 5 minutes to talk about business expenses. I just want to give you the landscape so that I make your life easier for next class. Okay? Now, unless anyone has any final questions on chapter 12. Matt G.
On that very last question, isn't this kind of similar to South Fork as well? Because
Well, it's not a sale. Okay? These are future royalty payments. So you could, but again, I'm just going on how the case actually held. Okay? Now you'll see, guys, chapter 14 is a lengthy chapter. Okay? We'll probably spend at least 2 classes on chapter 14. Now, chapter 14 deals with business deduction. And when you go shopping, I want you to think of different shopping carts, okay? And when you go shopping, you can put your purchases in possibly 1 of 3 baskets, right? And picture, if you will, you're picking up LED light bulbs. LED light bulbs. Can anyone take, of the 3 baskets, what might be the nature of one of your LED light bulbs? What kind of expenditure might it be? Personal expense, right? Your kitchen hi-hat is out, right? And you need a light bulb. What code section governs whether or not it's deductible?
162.
No, because it's not a business expense. Check out code section 262. Check out code section 262. What does code section 262 say? Personal expenses are not deductible, right? So we're going to find out throughout this chapter that many expenses people incur, they may try to label them business, but they will fall within the scope of being non-deductible personal expenses. EK, what's the problem? All right? Okay. Now you can pick up light bulbs for your office. What basket do those go in? They're 162, right? You need light in your accounting office, right? To make money. And the notion, by the way, sorry to resort to a cliche, but under the auspices, it takes money to make money, right? You're familiar with that cliche? If you spend money to make more money, that should give you an aroma of things that are deductible, right? If you spend money to make money, those kind of expenditures are generally deductible. You spend money to make money. Code section 162. What is the last basket? Mike?
Inventory. You're buying it to resell it.
That's true, but you and I don't usually go to Home Depot to buy inventory, nor does anyone else. So what I'm talking about is you go to buy a light bulb as part of a larger remodeling project, right? You're remodeling your entire office. And that's more in the nature of a capital expenditure. And those kind of capital expenditures are found within code section 263, meaning you can't deduct it immediately. You have to capitalize that expenditure and under normal depreciation rules, depreciated over its useful life. All right? So you have three different kinds of expenditures: personal, business, and capital. Now, if you open up to Code Section 162, let me just give you an idea of how these authors are going to handle this. What we're going to do as a class, or what the authors do, is they are going to unpackage Code Section 162, A1, 2, and 3. So if you look at Code Section 162, it says, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Right? So we have to figure out as a class, what do the words ordinary and necessary mean? And the first things the authors do is introduce us, guys, we have a great new case. When I say great, it's not a new case. It's one of the chestnut 10 cases that you should, in your tax career, know by name. Okay? So you got, what a bonanza this week and next. You got Lucas Fiero, you know, on the top 10 list of any tax professional. Helbring v. Horst, and I'm going to say, now I'm going to trip myself up. I got too many names. Welch v. Helbring. Welch v. Helbring. Big case. Big case. Discussing what is ordinary and necessary. And then we're going to discuss, literally in order, what is carrying on a trade or business. And then we're going to look at 162A1 and A2 for next class, time permitting. We're going to look at deductions for reasonable allowance for salaries and travel expenses. So for next class, you guys have to be a little bit more ambitious reading-wise, if you don't mind me making an observation. I would read ahead about 40 pages. I'm not sure exactly how far we'll get, but if you can read up to page, 350, well, let me just say, we should be able to get to that page 357, all right? I'll be ambitious, all right? I'm not exactly sure if we'll get that far, but if you could, that'd be great. I will see everyone here next Monday, okay?